Well, welcome to our High Rock Weekly video. If you're watching for the first time and interested in learning more about High Rock, please check out our website at www.highrockcapital.ca. I'm Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. Now, we normally use this time to chat about what we see happening in the global economy and in financial markets and the world of wealth management and how we are adjusting our investing strategy. But today, however, we're going to take a bit of a different approach. Paul, we are celebrating our third anniversary.
Yeah, it's the third anniversary of our private client division. We started that 3 years ago, obviously, and that's more than 7 years as an asset management firm. So we've more than tripled the size of our private client business in those 3 years. So I think we're doing something right, Scott.
Excellent, excellent. Well, let's remind our clients why we began our private client division.
Well, there are quite a few reasons, but I originally started High Rock, as I said, over 7 years ago, and the original intent was to manage 4 funds for a division within Bank of Nova Scotia. So we're currently registered with the Ontario, BC, and Alberta Securities Commissions. In 2015, I personally had a really hard time getting reasonable prices from my financial advisor, my stockbroker, for buying and selling securities, specifically corporate bonds for my own portfolio, my household portfolio. So I decided to start and build a private client business so I could get access to those bonds directly with the synergies from the Scotiabank funds, and that so other people could piggyback on our access to the markets and our experience in managing money and our platform that is significantly more cost-friendly and very transparent. And so I approached Scott, and you had been an advisor, Scott, for about 15 years or so at the time, and a branch manager at a couple places. And before that, we had worked together and met in 1990 as bond traders, and you'd been a vice president and a bond trader at a number of institutions, both in Toronto and New York. So that worked for me.
Well, and Paul, as he said, has been trading bonds since 1990. And prior to High Rock, spent most of his career at Merrill Lynch, where he was at one point head of Canadian credit trading. He's a chartered financial analyst and spends a great deal of time focused on research for investing purposes. We all have the highest levels of education available in the wealth and portfolio management industry, which you can read more about under the team tab if you go to our website. Well, we know that managing a family's wealth is about 3 main things, and we strive each and every day to do all 3 extremely well. Now, we have a number of unique aspects of our business, qualities that we think make us different and better than other portfolio managers and advisors. Our fiduciary duty is one.
Sorry, and our interests are truly aligned. We manage our own money exactly the same as client money. That's different than certainly the advisor network. We are the only portfolio management company in the country that manages money on a separately managed account platform that has hired a third-party compliance firm to act as an independent review committee for the sole benefit of our private clients. We do manage a fund for Bank of Nova Scotia. I think that's very unique. They show confidence in High Rock, and they do semi-annual due diligence. Both Scott and I have core competency in the complex, opaque, and over-the-counter bond market. Very hard to get access to that directly. That's one of the key differences of High Rock. Complete fee transparency. We're leading the way in describing exactly what the costs and fees are for all our clients. We are truly independent. Just Scott and I own the equity. It's all us. And I know at Merrill Lynch, the last number of years I was there, I was managing and had control over $13 billion of balance sheet. So I was there almost 18 years, know how to manage risk. Scott mentioned our education, very important. We do try to communicate with our clients. We do have discretionary authority over all accounts, but we try to communicate exactly what we're doing. and we're open to talking to anyone, any time of day. Now, this is a really important key one. We are registered with the Ontario Securities Commission, which is a government agency and reports into the Minister of Finance of Ontario. The investment dealer community and all the financial advisors, et cetera, that work at the banks and the dealers, they are regulated by IROC, the Investment Industries Regulatory Organization of Canada, which is, quite frankly, a self-regulatory body that is owned by the banks and the dealers. So there's a big difference in how you're registered.
And we have our own code of conduct at HIROC, a voluntary code of conduct that we've all signed, very much geared towards the premise that we will always put our clients' interests first. And you can see that in more detail on our website on the home page by clicking on our voluntary code of conduct button. Well, in the June 2017 edition of the Small Investors Protection Association monthly newsletter, HIROC was singled out and recognized for our leadership role in the investment industry as a new breed, where fiduciary responsibility and our clients' interests are our first priority. We think that this is a really important part of the conversation surrounding the management of wealth. At HIROC, you start with a wealth forecast that will identify your goals and allow us to tailor a long-term strategy to your very specific needs. We follow this with a portfolio strategy that is executed with our disciplined, active, and tactical portfolio management, which you may not get with many buy and hold style advisors.
And we also have our communication, our regular blogs. Scott and I write blogs, not every day, but most days. And then we have our weekly video, which we're doing now. And all of this form of communication keeps you up to date on what we're currently thinking about our portfolios and the markets. We have quarterly reports that we send out, semi-annual reviews, and quite frankly, as much interaction with the portfolio managers as you wish. And I think you would find that very few money managers, if any, would talk to their clients directly like that.
And just on a note of quarterly reports, we're actually just waiting for Raymond James to fix a line item in one of our summaries that we'll be sending to our clients very shortly. But we will have our first quarter reports coming to our clients in the next few days, we hope.
So as I mentioned, our private client division was established to take advantage of some of the synergies that come with the funds that we manage for Scotiabank. We are not stockbrokers, investment advisors, or financial advisors or salesmen who farm out their clients' money to other portfolio managers like HIROC, who then charge more fees.
We are a portfolio management company who has a clear understanding of wealth management. And unlike most advisors, we have a legal fiduciary responsibility to our clients, and our structure allows us to pass on these lower costs to you.
So our fees are simple and transparent, and we fully disclose any hidden or embedded fees, or those MERs that you hear about. And that is something that may not be the case with most advisors. In fact, we keep our costs down because we do not outsource portfolio management as many advisors do. So in a low return environment, which we are arguably in now, it's really important to pay attention to the costs of investing your money. And to illustrate just how important fees are, if you invested $1 million today with a bank advisor who bought you mutual funds, you would pay about $1.6 million more in fees over the next 30 years than compared to if you invested that $1 million today with HIROC. That $1.6 million over 30 years is your money.
And our discipline is in our strict adherence to your goals-oriented investing, our structured models, protecting your capital, regular rebalancing, in-depth research, fiduciary responsibility, and a very high level of client service, which includes ongoing monitoring and regular review with you of your wealth forecast to determine if we are meeting our targets.
At High Rock, we focus on the difference between the absolute returns and risk-adjusted returns. Again, this is the key to steady, less volatile portfolio swings, which help to elevate returns over longer periods of time. We manage risk first and foremost, and the returns are the result of well-managed risk.
And as most of our clients know, we have the three models which we can create balance and diversification: a fixed income model, a global equity model, and as well we have a model that focuses on Canadian small to mid-sized companies with which we have a great deal of familiarity and deep levels of research.
Yeah, and this is an active or tactical model, as we refer to it, the tactical model, and it's intended to obtain better than average growth by seeking out stocks and corporate bonds of companies that we believe are trading at prices well below their intrinsic value.
We use these models to create portfolio strategies that are in keeping with your desired goals, risk tolerance, and time horizon, as is determined by your wealth forecast. We manage our private client accounts on a separately managed account basis, which means your accounts are held under your name at Raymond James, one of the largest wealth management companies in North America. Many of our clients have had their accounts there in the past. They provide us with custodial and back office service for all of our High Rock clients. They are your accounts, though, and your securities. You just give us permission to do the appropriate trades in them. Well, High Rock's investing track record goes back, as Paul was saying, 7 years. Our private client division is now 3, and we have proven that our methods are successful. We buy assets, as Paul said, that we think represent value, as we did this week when the S&P 500 forward-looking PE ratio touched its 5-year average, and we'll buy more when the value becomes better, and that's how we do it. And while the main focus tends to be on equity markets, because that is what media focuses on, and that is historically where the general public has some modest knowledge and comfort, we know that there's plenty of other less volatile assets available that can provide just as good returns as stocks, if not better. So that is our specialty: finding, investing value in other, perhaps not as well known, but also perhaps somewhat safer asset classes that are not necessarily correlated to the wild swings that we've been seeing in equity markets. So if you know of anyone who might be interested in what we have to offer to you, please feel free to pass this on. We still have room for a few more clients. And finally, thank you to all of you, our clients, for putting your faith and trust in us. And thanks for tuning in, and have a great week.